Yes, welcome to this channel once again. My name is CP Otieno. Today we are going to discuss our lesson 7. Our lesson 7 today we want to talk about depreciation of fixed assets. If you look at International Accounting Standard 16 on property, plant and equipment, it outlines the accounting treatment for most types of property, plant and equipment. Property, plant and equipment is initially measured at its cost, subsequently measured either using a cost or revaluation model, and depreciated so that its depreciable amount is allocated on a systematic basis over its useful life. What is depreciation? The term depreciation refers to an accounting model used to allocate the cost of a tangible or physical asset over its useful life. Depreciation represents how much of an asset's value has been used. We defined an asset as a resource owned by the organization or a business as a result of past economic events from which future economic benefits are expected to flow to the business or the organization. Now, when we are talking about a fixed asset, we said that that is the asset that is expected to last for more than one financial period in the business. And when we talk about the tangible or physical asset, we are trying to refer to the asset which you can touch. Now, depreciation represents how much of an asset's value has been used. And it refers to that part of the original cost of an current asset that is consumed during its period of use by the business. The amount charged in a year for depreciation is based upon an estimate of how much of the overall economic usefulness of a non-current asset has been used up in that accounting period. If you want to try and link this information that is being provided here with the information that we got as we were trying to define what an asset is, we said that it is a resource that is owned and controlled by a business as a result of past economic events. Now, my point comes in at the point of from which future economic benefits are expected to flow to the business. Now, this underline that part, from which future economic benefits are expected to flow to the business. Now, I would say that this future economic benefit is not going to flow into the business forever. Everything that has got a starting point must have an ending point. Through prudence concept, you will have to make an assumption that this asset, this resource owned by the organization, is not going to stay in the business forever. And therefore, we have to estimate, we have to give an estimation of the useful time. We have to give it some time span for which the organization will be able to expect the future economic benefit that we had talked about. So here, we have said that the amount charged in a year for depreciation is based upon an estimate. So this thing, the estimate bit of it is that it's not an actual figure, but we are just trying to preempt a forecasted figure or something. Then also, you remember when we were talking about the matching concept, a concept which tries to guide accountants on how to treat expenses against incomes in terms of the cut points of the financial periods. The asset is going to take more than one accounting period for it to be a long-term asset, but then we cannot wait until the end or until the expiry of the time span of that asset, so that at that point in time, that is when we want to bring in the accumulated depreciation. We just have to allocate, we have to estimate the total amount of depreciation that we expect, or the reduction in value that we expect to experience. We apportion it bit by bit as we move towards the end of the expiry of the lifetime of that particular asset. So now you can see we have got causes of depreciation. Number one, we have wear and tear of the asset. Every machinery or tool is bound to wear out over a period of time. There will be parts that may need replacing or repairing. Usually, such assets have a fixed lifespan, after which they need to be scrapped. This wear and tear of the asset must be accounted for in financial terms, hence depreciation. If you purchase an asset today, which you expect to last for more than one financial period, then you have to expect that this item, number one, it's not going to stay forever. For example, you've purchased a computer. This computer may not stay forever. The computer, at some point in time, you'll realize that a number of things start transpiring in the life of that particular computer, which requires attention. And the attention that we are talking about here is the financial expense. It requires some money to be spent so that it can be brought back to the useful position. Let's say somebody has purchased a phone today. That phone, at some point in time, in the course of use, you realize that something happens without your intention. Maybe the screen of the phone cracks, things like that. Now, when you want to sell this phone to another person, you realize that the buyer of this phone, however much expensive the phone may have been, but then now the buyer would not want to purchase it at that specific price. I mean, if the buyer can be able to afford the original cost of the phone, then why should he take a second-hand phone? The buyer may decide to go with the amount that he has to the shop so that he can buy a brand new phone. If the phone was costing $70, then now the phone will be costing something like $50 based on the kind of agreement that they will have between the supplier and the customer. Now, the main point here is that at least after a given period of time, the supplier, both the supplier and the customer, can be able to look at the phone and say that because of 1, 2, 3, there is some cracks. We can see some maybe things like that. They can see the phone has started to wear out. So that is the wear and tear that we are talking about. It is just a natural thing that comes to any kind of asset. With the time, it grows old. That is the term to use. It grows old by default. The buyer will not accept a higher price or a price that is equivalent to the original cost. So that one tells you that the price, the phone's value shall have depreciated. The phone's value shall have reduced. So that reduction in value is what we call depreciation. And now, because this asset is something that we expect to stay for more than one financial period, for more than 12 months, we are trying to allocate and apportion the depreciable amount across the lifetime of that particular asset. That is all about depreciation. Another cause is usage right expiration. Some assets such as software and licenses have a typical time span over which it can be used. As soon as this time span finishes, the owner has to give up using the asset. So the depreciation of this asset must be done over time. It cannot just be written off on the day of expiration. That is what we had just explained in the above cause, which is wear and tear. And when we are talking about the cause, which is as a result of usage right expiration, remember, we also have got some of the assets like machinery that the business may get control or ownership of because of some lease agreements. When the lease agreement period expires, then definitely the assets changes ownership and control from the business owner to the owner, the actual owner of that asset. So because of that expiry of time, the expiry of the agreement, the business or the owner of the asset has to pick up the asset. So the business now remains without that asset. So within the period of use, by the time the owner of the business is in control of this asset, at least it is prudent for the business owner to allocate some depreciable amount across the useful life of that asset. By the time the business is still able to gain some economic benefit from that particular asset when it is still in use. So that one cannot be done on the day of expiration. It has to be done across equally within the period that is allowed, by the agreement terms. So the other thing that we also need to talk about as cause of depreciation is there is something called obsolescence. When somebody says that an item is obsolete, then it means that that asset is something that is out of date. Another cause of depreciation is the obsolete nature of certain assets. Over a period of time, every asset loses its novel value. A new alternative can always be developed for replacing an asset and its functions. With inventions and innovations, things have come up, and now we even have the USBs, the flash disk. We have so many items that can be used to replace the CDs and the DVDs, which were very fragile, and again, they were taking much space, much storage space. Now, this one is normally being caused by the innovations and inventions that normally occur. So when people come up with new ways of doing things, when people come up with more or much better, efficient and effective gadgets or machines that can carry out the same function that was also being carried out by a previous gadget or machine, then you realize that gradually people are trying to leave, or rather people are trying to graduate from that previous or old machinery into the new one that takes little time and gives the same result or a better result. So this one leaves the previous machinery or the old concept that was there in the previous gadget or machinery to be obsolete. So the obsolescence here is realized as a result of the new invention or innovation of new gadgets and machineries that can be used. So when somebody says that an item is obsolete, then simply this person is talking about an item which is outdated. Now, the other bit is inadequacy. When we talk about inadequacy, this normally arises when an asset becomes incapable of carrying out some functions of the business because of the growth and changes in size of the business operations. Now, at this point, we would say that when an item was being used or a machinery was being used, and then you realize that because of growth in demand and the business is trying to work hard so that it can be able to satisfy the excess demand that is brought about by the new changes, or rather the new forces in the market. There are so many things that we can talk about that can bring about the increase in the demand. So at this particular point in time, you see there will be need for the organization to upgrade, or rather to graduate upwards in terms of the production. When production is expected to go up, and then you realize that the current machinery that you have in the organization cannot be able to satisfy that kind of production extent, then there will be need for the organization to go for a bigger machinery or a much more complicated machinery that can be able to beat that standard. Because the current machinery cannot produce up to standard, that one is just a cause that is making a new machinery to be brought on board. Now, the previous machinery in the business, you realize that one, its value will definitely go down because it's now something that cannot be able to satisfy the interest of the organization or of the user. Now, with that, you would say that that machinery has reduced in value. But it doesn't mean that that machinery has to reduce in terms of wear and tear. It might be in good state, yes, and we could even have a new one, that a brand new machinery of the same kind, which is still at the supplier's point. It has not even been purchased yet. And some people could still even, by the way, go for it at the same price, because it can be able to satisfy their interest. But in this particular organization, it is important for the organization to realize that the machinery has gone down in value, so it cannot be able to really help the organization. So that is the value the reduction in value that we are talking about. So in each and every organization, things do happen in different ways, and then they can also be able to make different kind of considerations based on the kind of decisions and maybe ideas and operations of each and every organization. It can also happen the other way around, that we can have a big machinery. The organization is using a big machinery, but then with the reduction in demand because of changes in fashion and what have you, that one changes the perception of the consumers, and then the reduction in consumption and reduction in demand comes in. So when that one happens, by default, you realize that the organization cannot be able to proceed with the production using the big machine that they had earlier, because that one may call for much cost, which is not cost effective. So because of that, then the organization may decide to downsize and get a better machine, which is of small size or something of the sort. And if actually the organization perceives that kind of change to stay constant for a longer period of time, then the organization will have to, because of those forces of the market, it will have to change with the forces of the market and get a better machinery which can perform up to the expected standard. Another cause is something called depletion. This is normally experienced in assets with a wasting character like the mines, quarries, and oil wells. As the valuable product is extracted from the natural resource, it reduces in value. This is to say that, for example, in the mines where gold are being extracted, you realize that with the time, as you continue extracting the valuable product from that kind of land, then we would say that the value of that land will go down day in, day out. If somebody was to purchase that piece of land full of the mineral resource, then you would say that that piece of land could have been sold at a very high cost as compared to when the owner of the business has first of all given room for somebody to extract out the valuable materials from that piece of land. Then you sell it when it is now almost exhausted. At that point in time, it goes without saying that that piece of land shall have reduced its value, because the mineral resource or the valuable materials have been extracted from that piece of land. So, but most of the time, this is not to say that we'll be allocating depreciation cost on land. I would say that that is a very unique circumstance, and that's why we don't normally provide depreciation on land. We don't provide depreciation on land. Instead, land we normally expect it to grow in value, which we call appreciation. But then we don't always also provide that appreciation. Somebody would ask that now, when you are providing depreciation where it is necessary, then why don't we also provide appreciation on land? Then we would say that because of the prudence concept, accountants are trying to be pessimistic of the future. So even if you know that the land will appreciate in value, you be a bit slow in accepting that fact. So you don't provide that because it will increase the income of the organization. And when the income grows, you just know what will happen. It means that you will pay a lot of taxes, which is against the wish of the management of the organization. We don't need to provide for appreciation of land. I believe that all of us have now known what depreciation is, and we have also known the causes, things that normally cause depreciation. So again, we want to talk about the terms used in calculation of depreciation expense. The first term that we have here is called useful life. This refers to an accounting estimate of the number of years an asset is likely to remain in service for the purpose of cost-effective revenue generation. The most important bit of it there is the likelihood of an asset remaining in operation for the purpose of cost-effective revenue generation. We all know that an asset is being kept in the organization with an expectation to gain future economic benefits. So in the process of trying to generate revenue by using the assets, you realize that, the asset may stay in the organization to the extent that now it becomes not cost effective to operate with. We would say that this is the period that the organization can be able to use that particular asset in the business in terms of generation of revenue to the extent that it will still be cost effective for that business to use that particular asset. Otherwise, if it becomes not cost effective for the organization to use that particular asset, then it would better be disposed of and a new asset be adopted by the organization. The other thing that we can talk about here is the residual value. This refers to the estimated amount that an asset owner would earn by disposing of the asset less any disposal cost. The residual value is the value that can be recovered by the organization at the end of the useful life when the organization decides to dispose of that particular asset. We have carrying amount or carrying value. This refers to the cost of an asset less accumulated depreciation. If we have calculated the depreciation and then we said that the depreciation is supposed to be a portion, we say that the depreciation expense is supposed to be charged in every particular year within which the organization is still considering that particular asset to be of use or within the useful life of the asset. So in each particular year, we normally charge depreciation expense. Let's say the organization has given an asset a useful life of like 10 years. At the end of the 5th year, for example, we shall have had some expense or depreciation expense that have been accumulated in the 1st, 2nd, 3rd year and the 4th year and even the 5th year. So we accumulate all of them and then we deduct that amount from the original cost. Then the amount that is left there is what we call the carrying value. The other thing that we need to talk about here is the depreciation rate. The depreciation rate is the percentage rate at which assets or an asset is depreciated across the estimated productive life of that particular asset. So it is that percentage that has been allocated for charging depreciation for that particular asset. So that is what we call depreciation rate. And then after that, I think we just have to talk about the methods of calculating depreciation. And today we just want to look at the main methods which are used globally. The rest we'll look at later, but the main ones starting from straight line method. In this method, the estimated residual value of an asset is deducted from its carrying cost, and the balance is divided by the estimated useful life of an asset, which is always estimated in years. This method assumes that the organization will draw economic benefit from that particular asset in equal measure over its estimated useful life, hence allocating equal amounts of depreciation expense over the years. The formula of calculating depreciation expense using the straight line method, you just have to get the cost, the original cost of the asset, then we less the estimated residual value which we had already explained, then now you divide it by the estimated useful life. And that one is normally being given in what? In terms of years. So once we are done with that, then I want us to look at an illustration. A car was bought at a cost of $22,000. It was expected to last in the business for only 4 years and then dispose it off at a cost of $2,000. Required: A. Calculate the annual depreciation expense amount using straight line method. Now in solution, you will say that the depreciation expense per year is calculated by taking the total cost, the original cost, minus the estimated residual value over estimated useful life in years. So the cost was $22,000 and then you have to less $2,000, which is the residual value of that particular asset, and then you divide the result by 4. Now then, when you take 22,000 minus 2,000, you'll get $20,000. Then you divide that by 4 and you'll get $5,000. So the depreciation expense which we are going to charge per year is $5,000. And that is now how we calculate depreciation expense using a straight line method. So part B of the same question is saying, calculate the annual depreciation expense amount using straight line method, assuming the organization doesn't expect any residual amount at the end of the estimated useful life. Now, in our solution, you'll have cost minus estimated residual value over estimated useful life. Now, at this point, you say the cost was $22,000, and now in this question, this part we are being told that the residual value is 0. So you take 22,000 minus 0 over 4. So that will be $22,000 over 4 years, which is $5,500. So that is our depreciable amount that we'll be charging across the useful life of the product. So in year 1, we'll be charging 5,500, year 2, the same amount, 3 and 4. That is how we'll be calculating the depreciation using straight line method. Now, the other thing, we have another method is the reducing balance method. The reducing balance method, this is where a fixed percentage of the depreciation is deducted from the cost of the product in the first year, and in the second and in the subsequent years, we use the same percentage that had already been calculated. So the same percentage is being charged on the carrying amounts. Now the carrying amounts here, we had already said that the carrying amount is the cost minus accumulated depreciation. So at each and every stage, you just pick the cost, the original cost, minus the accumulated depreciation up to the point at which you are now expected to calculate your depreciation. You deduct the accumulated depreciation, that is for, it is accumulated because now we pick for depreciation expense for year 1, 2, 3 up to the one that you intend to calculate the depreciation expense for. So you pick the ones that have already been taken into consideration, and you sum them up, then you deduct them from the cost of that particular product. When you do that, you deduct them from that particular asset. When you do that, then you end up with something called the carrying value. This method is also known as the diminishing balance method or the diminishing debit balance method. So that is how we calculate depreciation using the reducing balance method. And then we can also see an illustration that we can be able to at least get to absorb or internalize the information that we've gathered concerning the reducing balance method. So the illustration is talking about a machine is bought at a cost of $10,000 and the depreciation is to be charged at a cost of 20%. And the calculation of depreciation expense would be done as follows. Now, if you are asked, for example, that you calculate depreciation using the reducing balance method, in this case, you would say, we have the cost, which is 10,000, and you've been given the depreciation charge in terms of percentage. So it is 20%. So in year 1, you just pick 20% of the $10,000 and you get your 2,000. Then in year 2, you'll have 20% times the carrying value. The carrying value here will be the cost minus the accumulated depreciation. So the amount that we have accumulated as depreciation at the end of year 2, we have got the first year's depreciation, which was $2,000. Deduct that one from the $10,000 and then you get $8,000. You subject that $8,000 to 20% and then you will get something like $1,600. So that will be the depreciation for the second year. So this will be the expense that is being charged for the second year. Now, when you go to year 3, you will just take 20% times the carrying value, and the carrying value at this point shall be $10,000 minus the depreciation expense that was charged in the earlier year or in the first year minus the depreciation expense that was charged in the second year, which was 1,600. You sum the two, you'll get $3,600, which is the accumulated depreciation. So you take the original cost minus the accumulated depreciation, and then you get your figure. Then subject that to 20% of the depreciation, then you'll get $1,280. So that is the depreciation for the third year. You go on and on up to the point as per the expectation of the question or the examiner. Now, carrying amount at the end of the 3 years shall be 10,000 minus the total depreciations that we've had in the first, second, and the third year, which is giving us 4,880. So if you less that from $10,000, then you'll end up with $5,120. So that is the net book value that will be expected to be seen on the face of the financial statement, on the face of the statement of financial position. So that is how we calculate depreciation using the reducing balance method. Now, the formula used to find the percentage to apply in this method is the depreciation rate is equal to 1 minus the nth root of S over C. Now let us see the meaning of each and every item that is captured in that formula, so that at least we can be able to just pick the figures relating to those particular items and replace in the formula. Now, the R is the rate of depreciation expense. Then N is the number of years, which is the useful life. Then S is the residual value, and then C is the cost of the asset. That is the end of our lesson 7. In our lesson 8, we'll do much of the depreciation still, so that we get to understand the details of depreciation, so that by the time we'll be picking a question to handle on depreciation, you can be able to handle any question coming from whichever corner. So up to this point, I want to say that I'm so grateful for the time that you've taken to watch this content, and I just want to remind you once again, kindly take your time to subscribe to this channel. Now, if you are a returning subscriber, I consider you part of this family. So let us continue working together. I know you'll get to understand better concepts of accounts using our channel here. And now for the new viewers, welcome you so much to this channel. You'll get much more information from this channel. You'll not be disappointed and you will not regret it. So keep on tuning in to this channel. Remember to subscribe before you leave. Remember to subscribe before you leave. If at all you'd be having a question or a comment, you have the comment section there down below. You can put it there. And remember to like the video, share, and do the necessary. You can also click on the notification bell so that anytime I post a video of the same kind, you be among the people that will receive the notification. Thank you so much, guys. Once again, my name is CP Otieno.